Please welcome Leo Dirac.
Thanks, Brady. So I'm here to talk about venture capital term sheets, and I'm going to try to talk a little slower than I did last time. Let me know how I did. So to start out, I'm going to explain what venture capital is and when it's appropriate, what kind of startups it's good for. And then we're going to talk about term sheets and some things you really need to pay attention to. And at the end, I hope you get the impression that there's some kind of reason for all the craziness that seems to be going on. The first thing you need to know when thinking about VCs is that they're not investing their own money. They start out by pooling a whole lot of money from investors, and then they distribute it to startups. But the investors are expecting their money back at some point, generally like 10 years later. So this means that VC is really good for companies that have a big opportunity. They need millions of dollars, and they can turn it around really fast. Generally, they only have like 3 to 5 years to turn this money around into an exit, which is an acquisition or an IPO. VC is not appropriate for slow growth companies or lifestyle businesses. In fact, VCs have a term for companies like this that aren't approaching an exit.
The living dead.
So let's talk about term sheets. A term sheet is a short document that describes all the important things to do with an investment. And it's just a lot easier to work with than 100 pages of legalese being bounced back and forth. So this talks about things like how much money is being invested, who's involved, and how everything gets distributed at the end of the day. One really important thing in the term sheet is the pre-money valuation. This says how much the company's ideas are worth and any other assets they have before the investment. Now, it's kind of arbitrary, so don't get too hung up on it. Now, I might say, my company's worth $6 million for all the work we've done. And then the VCs throw in $2 million of real, genuine, hard cash, and they get 25% ownership of the company. So you might think that this means that later on, when the company gets sold for $100 million, that I'm going to get 75% of that, and the VCs are going to take their $25 million and be happy. No, it generally doesn't work that way because of some things called liquidation preference. So liquidation preference is the idea that when there's a liquidation event, the VCs get preference. This is kind of insurance for them. In case the company doesn't get sold for as much as they were hoping for, they want to make sure that they get their money back first. And if there's anything left over, then it can kind of be spread out amongst the other people. If you look at it visually, up to a certain exit value, the VCs take everything. And then beyond that, the payout lines have a slope, which is determined by their ownership fraction. So the valuation determines the slope of these lines, but the intercept's really important too. Look at it another way. If a company is extremely successful and the exit value is really high, I'm going to get close to my 75%. But at low to moderate valuations, the VCs are taking kind of more than their proportional share. So the amount that the liquidation preference is set at is in the term sheet. Sometimes the VCs just want their money back. Sometimes they want double it. And sometimes they want a 3x liquidation preference. This is a really important number to pay attention to in a term sheet. So you got to read this one. Now, some people look at this and think, this is completely bogus. Those venture capitalists are just screwing us. We're the entrepreneurs. We've got the ideas to make things happen. Why do they need all these crazy terms? Can't they just take regular common stock like everybody else? Well, I mean, okay, so imagine they did take common stock and they only took 25% ownership of the company. That means they could be outvoted in just about anything that the owners wanted to do, and this leads to all sorts of mischief. For example, as soon as that $2 million check from the VCs gets to the company's bank account, then as a CEO, I might say the best thing for us to do with this company is to give it back to the shareholders. It's a dividend, yeah. And the VCs would be absolutely powerless to stop us. So they need some kind of control. And it's not because they're trying to cheat us. They're just trying to they're just trying to protect their investments. And without VC, remember, your idea isn't a company. It's just an idea. So all these things in the term sheet, they actually have a good reason for them. As another example, consider cumulative dividends. This is the idea that over time, the amount of money that the VCs are guaranteed increases. And this is great because it exactly lines up the incentives of the managers to get to a quick exit, which is exactly what the investors want. So if you're looking at a VC term sheet, get some professional advice, hire a really good lawyer, and be sure and look at what's called the waterfall chart, which describes how the payouts are going to work. And understand their motivations too. Don't make this an adversarial us versus them thing, because then nobody's going to win. So I'd like to thank my finance professor from UW, Lance Young, who taught me most of the stuff. And if you check my blog tomorrow, embracingchaos.com, I'll post these slides and some spreadsheets for you guys to play with. Thank you very much.
Thanks, Leo. That was awesome.